The Four Pillars of Investing by William J. Bernstein. This book provides a comprehensive overview of investing, with a focus on asset allocation, diversification, and risk management. It has been a bestseller for many years and is likely to remain popular in the coming years. Here are the key ideas from the book. 1. Diversification is key to reducing investment risk. Diversification is a fundamental principle of investing that helps to reduce risk by spreading an investor's money across a variety of different assets such as stocks, bonds, and real estate, rather than investing in just one or a few individual investments. By diversifying, an investor can help to mitigate the risk of losses that may occur from any single investment. This is because different investments may perform differently in different market conditions, and diversification helps to ensure that an investor's portfolio is not overly reliant on the performance of any single asset. 2. Long-term returns are driven by economic growth and productivity, not short-term market fluctuations. Long-term returns on investments are generally driven by economic growth and productivity, rather than short-term market fluctuations or news events. While market fluctuations and news events can certainly impact short-term returns, it's important for investors to take a long-term view of their investments and focus on factors that are likely to drive returns over the long term, such as economic growth, technological advancements, and changes in consumer behavior. By focusing on these factors, investors can help to avoid making impulsive decisions based on short-term market movements and stay on track towards their long-term investment goals. 3. Asset allocation is crucial to achieving investment goals. Asset allocation is a critical factor in achieving investment goals, as it involves determining the optimal mix of different asset classes, such as stocks, bonds, and cash, to meet an investor's specific investment objectives and risk tolerance. By diversifying across different asset classes, an investor can potentially achieve better returns while reducing risk, as different asset classes tend to perform differently under various market conditions. Asset allocation can also help to align an investor's portfolio with their investment goals and time horizon, as different asset classes may be more suitable for different investment objectives, example, growth versus income. Ultimately, asset allocation is an important tool for investors to help achieve their long-term financial goals while managing risk along the way. 4. Active trading and market timing are unlikely to consistently beat passive investing. Active trading and market timing are strategies that involve attempting to outperform the market by making frequent trades or trying to time market movements. While these strategies may occasionally lead to short-term gains, numerous studies have shown that over the long term, they are unlikely to consistently beat passive investing, which involves holding a diversified portfolio of low-cost index funds or ETFs that track the performance of a market index. One reason for this is that active trading and market timing often involve higher costs in terms of fees, taxes, and transaction costs, which can erode investment returns. In addition, it's difficult to consistently predict market movements and identify individual stocks or securities that will outperform the market over the long term. By contrast, passive investing offers investors a low-cost, diversified approach that allows them to capture broad market returns without trying to predict market movements or pick individual stocks. 5. Don't try to time the market or chase after hot stocks. Trying to time the market or chase after hot stocks can be a risky and ineffective investment strategy. Market timing involves trying to predict when to buy and sell securities based on market movements, while chasing after hot stocks involves investing in companies that have recently experienced high levels of growth or popularity, in the hopes of profiting from future gains. The problem with these strategies is that they rely on being able to accurately predict market movements or the performance of individual stocks, which is extremely difficult to do consistently. In fact, attempting to time the market or pick hot stocks can often lead to costly mistakes, such as buying high and selling low, missing out on market gains, and incurring high transaction costs and taxes. Instead, a more prudent approach to investing is to focus on asset allocation, diversification, and maintaining a long-term perspective. By investing in a diversified portfolio of low-cost index funds or ETFs that track the performance of a broad market index, Investors can potentially capture market returns over the long term without trying to predict market movements or pick individual stocks. 6. Low-cost index funds are an effective way to build a diversified portfolio. Low-cost index funds are a popular and effective way to build a diversified portfolio. An index fund is a type of mutual fund or ETF that tracks the performance of a specific market index, such as the S&P 500 or the total stock market index. By investing in an index fund, investors can gain exposure to a broad range of stocks or other securities in the market. Low-cost index funds are particularly attractive because they offer a number of advantages over actively managed funds, including lower fees and expenses, greater tax efficiency, and greater transparency. In addition, index funds are typically well diversified, as they invest in a large number of different companies across various sectors and industries. This helps to reduce risk and potentially enhance returns over the long term. Overall, low-cost index funds can be an effective and simple way for investors to gain exposure to the stock market and build a diversified investment portfolio. 7. Investors should have a clear understanding of their risk tolerance. It's important for investors to have a clear understanding of their risk tolerance, which refers to the level of risk an investor is willing and able to tolerate in their investment portfolio. Understanding your risk tolerance is crucial because it can help you make informed decisions about how to invest your money and help you avoid making emotional investment decisions that may not be aligned with your long-term financial goals. Your risk tolerance is influenced by a number of factors, including your investment objectives, your time horizon, your financial situation, and your personal preferences. For example, if you have a longer time horizon and are investing for retirement, you may be willing to take on more risk in your portfolio in order to potentially achieve higher returns over the long term. On the other hand, if you have a shorter time horizon or need to preserve capital, you may be more risk-averse and prefer to invest in lower-risk assets. By having a clear understanding of your risk tolerance, you can create an investment plan that is tailored to your specific needs and goals. This can help you make more informed investment decisions and stay on track towards achieving your long-term financial objectives. 8. A portfolio's asset allocation should reflect an investor's risk tolerance, investment goals, and time horizon. A portfolio's asset allocation is the mix of different asset classes, such as stocks, bonds, and cash, that an investor holds in their portfolio. The asset allocation should be based on an investor's risk tolerance, investment goals, and time horizon. An investor's risk tolerance is the level of risk they are willing to take in their portfolio, and it is influenced by factors such as their age, financial situation, and investment objectives. For example, an investor who is younger and has a longer time horizon may be able to tolerate more risk in their portfolio, while an investor who is closer to retirement may want to take on less risk in order to preserve their capital. Investment goals are another important factor to consider when determining an asset allocation. For example, an investor who is investing for retirement may have a different asset allocation than an investor who is saving for a down payment on a house. Finally, an investor's time horizon is also an important consideration. A longer time horizon may allow for more aggressive investments, while a shorter time horizon may require more conservative investments in order to preserve capital. Overall, a portfolio's asset allocation should reflect an investor's unique circumstances, including their risk tolerance, investment goals, and time horizon. By taking these factors into account, an investor can create an investment plan that is well suited to their needs and objectives, and that can help them achieve their long-term financial goals. 9. The importance of compounding and the power of starting early with investing. The concept of compounding is a key principle in investing, and it refers to the process of earning returns on your initial investment, as well as on the returns that your investment generates over time. Starting early with investing is particularly powerful because it allows for more time for compounding to work its magic. Even small amounts invested regularly can grow significantly over time, thanks to the power of compounding. For example, if you were to invest $100 per month for 30 years with a 7% annual return, your investment would grow to over $100,000 by the end of the 30-year period. the power of starting early with investing is also evident when you compare two investors who invest the same amount of money, but one starts investing earlier than the other. The investor who starts earlier will generally have a larger investment portfolio by the time they retire, thanks to the added time for compounding to work. Overall, the concept of compounding and the power of starting early with investing highlight the importance of taking a long-term perspective when it comes to investing. By starting early and allowing your investments to grow over time, you can potentially achieve significant returns and build a strong financial foundation for the future. 10. Avoid high fees and expenses that can eat away at investment returns. High fees and expenses can significantly impact investment returns over the long term. For example, if an investment charges an annual fee of 1%, that means that 1% of the investor's assets will be deducted from their account each year, regardless of whether the investment is performing well or not. Over time, these fees can add up to a substantial amount, reducing the overall return on the investment. Therefore, investors should be mindful of the fees and expenses associated with their investments and aim to keep them as low as possible. One way to do this is to invest in low-cost index funds or exchange-traded funds, ETFs, which typically have lower fees compared to actively managed funds. Additionally, investors can choose a discount broker or robo-advisor that charges lower fees for investment services. By keeping fees and expenses low, investors can help maximize their investment returns over time. 11. The role of bonds in a portfolio as a way to provide stability and reduce risk. Bonds play an important role in a portfolio as a way to provide stability and reduce risk. Unlike stocks, which can be volatile and have a higher risk of losing value, bonds are generally considered to be less risky and more stable. They offer a fixed income stream, typically paid out as interest, and have a set maturity date at which point the principal is repaid. Including bonds in a portfolio can help to reduce overall portfolio risk because they tend to have a low correlation with stocks. This means that when stocks are performing poorly, bonds may still be able to provide positive returns, which can help to offset losses in the stock portion of the portfolio. In addition, bonds generally have a lower volatility than stocks, which can help to smooth out overall portfolio performance. Investors can choose from a variety of different types of bonds, including government bonds, corporate bonds, municipal bonds, and international bonds, each of which have their own risk and return characteristics. By diversifying across different types of bonds, investors can help to further reduce risk and increase stability in their portfolio. Overall, bonds can be an important component of a well-diversified portfolio, helping to provide stability and reduce risk. Particularly for investors who are more risk-averse or nearing retirement and looking to preserve capital. 12. Rebalancing a portfolio periodically can help maintain the desired asset allocation. Rebalancing a portfolio periodically can help to maintain the desired asset allocation, which is the mix of different asset classes, such as stocks, bonds, and cash, that an investor has chosen to hold in their portfolio. Asset allocation is an important consideration in investing because it can have a significant impact on overall portfolio risk and return. Over time, as different asset classes perform differently, the asset allocation of a portfolio can drift away from the original target. For example, if stocks have been performing well and the portfolio was initially 60% stocks and 40% bonds, it may now be 70% stocks and 30% bonds. This shift in asset allocation can result in a portfolio that is more risky than the investor intended. Rebalancing involves selling some of the assets that have performed well, in this case, stocks, and buying assets that have underperformed, bonds, in order to bring the portfolio back to its original target allocation. By doing so, the investor is effectively selling high and buying low, which can help to improve long-term portfolio returns. The frequency of rebalancing will depend on the investor's individual circumstances and investment strategy, but many investors choose to rebalance annually or when their portfolio's asset allocation deviates significantly from the target allocation. By periodically rebalancing a portfolio, investors can help to maintain their desired asset allocation and potentially improve their investment outcomes over the long term. 13. Investors should be aware of the impact of taxes on investment returns. Taxes can have a significant impact on investment returns, and it's important for investors to be aware of the potential tax implications of their investment decisions. In particular, investors should be mindful of the following. Capital gains taxes. When an investor sells an investment for a profit, they will typically owe capital gains taxes on the amount of the gain. The tax rate will depend on how long the investment was held, with long-term gains generally taxed at a lower rate than short-term gains. Dividend taxes. When an investor receives dividends from an investment, they will owe taxes on those dividends, which can also vary based on the length of time the investment was held and the investor's tax bracket. Tax-efficient investing. Certain types of investments, such as municipal bonds, may be exempt from federal or state taxes, making them more tax efficient for investors in high tax brackets. Tax loss harvesting. Investors can sell investments that have lost value in order to offset gains in other investments and reduce their tax bill. Retirement accounts. Investing in tax-advantaged retirement accounts such as 401(k)s or IRAs can help investors reduce their current tax bill while also providing a vehicle for tax-deferred growth. By being mindful of the potential tax implications of their investment decisions, investors can help to minimize their tax burden and improve their overall investment returns. It's a good idea for investors to work with a financial advisor or tax professional who can help them understand the tax implications of their investments and develop a tax-efficient investment strategy. 14. Avoid emotional decision-making and stick to a disciplined investment strategy. Avoiding emotional decision-making and sticking to a disciplined investment strategy is important for investors to achieve long-term investment success. Emotions such as fear, greed, and panic can lead investors to make irrational decisions that can have a negative impact on their portfolio. For example, during a market downturn, it can be tempting to sell off investments in a panic, potentially locking in losses and missing out on any potential market recovery. Similarly, during a market upswing, investors may be tempted to chase after high-performing investments, potentially buying in at a peak and risking a subsequent downturn. A disciplined investment strategy, on the other hand, involves creating a plan that is tailored to an investor's individual goals, risk tolerance, and time horizon, and then sticking to that plan through market ups and downs. This may involve regular contributions to a well-diversified portfolio, periodic rebalancing, and a long-term focus that looks beyond short-term market fluctuations. By sticking to a disciplined investment strategy, investors can help to avoid making emotional decisions that could harm their portfolio and potentially improve their investment outcomes over the long term. Additionally, working with a financial advisor can provide investors with the guidance and support they need to stay on track and achieve their investment goals. 15. Investment success is largely determined by investor behavior, not investment returns. Investment success is largely determined by investor behavior, not investment returns. This is because even the best investment strategy and the most skilled investment manager cannot guarantee positive investment returns, but investors can control their own behavior. Investor behavior can have a significant impact on investment outcomes. For example, if investors panic and sell off their investments during a market downturn, they may miss out on any potential market recovery and lock in losses. Similarly, if investors become overly optimistic and take on too much risk, they may experience significant losses in a market downturn. On the other hand, investors who remain disciplined, focused on their long-term goals, and avoid making impulsive investment decisions are more likely to achieve investment success over the long term. This means sticking to a well-thought-out investment plan, maintaining a diversified portfolio, and avoiding emotional decision-making. Investors who work with a financial advisor can benefit from professional guidance and support to help them develop and maintain a disciplined investment approach. By focusing on their behavior and making smart investment decisions, investors can potentially improve their investment outcomes and achieve long-term investment success. Please hit the subscribe button for the support of our channel and share our videos for more new upcoming content. We are very happy to create new ideas and review for everyone. God bless and happy listening.